Hey everyone, welcome to the final bar. Today, my guest is Frank Cappelleri, joining us from the New York area. He's with Instinet, great technical analyst, going to talk about his big picture view of the equity environment and the emotional state of investors, how that's evolving. We're going to look at the market that continues to climb this wall of worry, continues to chip away at new highs, with today financials, industrials leading the way higher. So what does this mean for the long-term trends? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the market activity from a technical perspective. Think about the behavioral, emotional guideposts that we can track, understanding the short-term environment, but most importantly, connecting it to the long-term. And I think now more than ever, as we see a market continuing to be resilient, continuing to go to new highs, think about how you're positioned for that, both position-wise, but also position mentally, understanding a market that continues to move higher in the face of all the uncertainty we have around us. The benefit, I would argue, of the charts is that all the stuff happening is baked into the price in terms of where supply and demand is evolving, where people are at, investors are at emotionally, and where they're making their bets. So if you're understanding the momentum, understanding how those trends are evolving overall, you're going to be on the right side of things. So we'll try to unpack some of those questions together. Coming up on StockCharts TV, we have some fantastic guests. Frank Cappelleri joining us today is an exceptionally good analyst, and it'd be good to hear his take. Tomorrow we have Greg Harmon, who's a fellow Cleveland native, along with myself, joining us on the 4th on tomorrow. And then next week we have Dana Lyons on the 9th. On the 10th we have Mark Ungewitter. Two other things to point out for you. On Monday, June 8th, our next episode of Behind the Charts features a conversation with Price Headley. I talked with Price at a money show a couple months ago and talked about his process, his background, particularly about how you deal with position sizing, which I thought was a really interesting conversation. So you're going to want to hear his take on that. He focuses on the options market, but I think his comments are relevant to any asset class. And then also really excited to announce a special week we have coming up, the week of July 13th, called Charting the Second Half. And all of our Stock Charts contributors, some special guests, are going to be providing their mid-year update on where they're seeing things, their outlook for the rest of 2020. It's going to be special broadcasts. All of our shows are going to feature some special content. We'll have a market outlook panel featuring some of our commentators. It's going to be a really, really cool week. So mark it down now. The week of July 13th is going to be a really special week for Stock Charts TV, hopefully empowering you, getting ready for the second half of the year. Let's get to our market recap. So as I mentioned in the introduction, the S&P just continues to chip its way higher. The S&P up 1.33% today to finish just under 3123, which is another sort of new high for this swing, continuing to establish itself above the 200-day moving average, which was such an important level. So many of us identified the 3,000 level being key, the 200-day moving average being key. We've eclipsed those, and the short-term trend remains positive. So I think until proven otherwise, the trend is long and strong and going up, and I think that's how you want to think about it. Mid caps and small caps up pretty big today. So the S&P 600, the small cap index, up 3.5% to just under 850. So this was more of an offense-led sort of environment, higher beta, higher risk types of names leading the way higher. The Nasdaq 100 lagging behind the S&P a bit today, only up 0.5%. You saw the technology sector sort of in the lower half of the sector list. So we continue to see this rotation away from tech and into some of these other sectors. And we're going to do a deep dive on financial stocks later. Think about some of the different components and how they're moving right now. But worth paying attention to some of these groups that continue to bubble up to the top, potentially taking the torch and moving the S&P onto to further highs. The VIX down today, back below 26 now. Let's look at a daily chart of the S&P. As I mentioned, this congestion range, this resistance range we talked about has been broken, has been eclipsed. Short-term trend is positive. We've seen that confirmed in a lot of different ways, and breadth characteristics. We'll look at some breadth later in the show, but overall very positive. The S&P daily chart now nearing an overbought condition, which again, on its surface is not necessarily a bad thing. That just means things have gone up a lot. You saw here in mid-November of last year, it was overbought. A bit of a short-term pullback, but overall it spoke to the strength of the trend. So just being overbought on its own is not necessarily predictive. It describes the characteristics of things. Where I would be concerned is you start to see some sort of divergence. If the price goes higher and you see that not confirmed by the RSI, we've not seen that yet. We've seen new highs in price be met with new highs in momentum, suggesting the uptrend is in fairly decent shape here, especially on that medium-term time frame, which we've talked about previously. So what else happened today? Let's look at some of the other asset classes. Bonds down today, big gap down today. By the end of the day, sort of chopped around, didn't make any other further gains after lunch, but overall the damage had been done. This pushes the TLT below 160 for the first time in quite a while. And when you think about the fixed income markets, we talked a little bit about this before, but it's now broken down through the 50-day moving average, broken down through the most recent swing low. So certainly feels like a rotation lower for bonds. Peter Brandt was on the show yesterday talking about long-term seeing this bullish move in bonds, and in the short term, we're not seeing that. Certainly seeing more price weakness than strength as the 10-year yield coming up a little bit. Continuing on, you can see in the commodity space, commodities sort of flat for the day. The USO, our main measure of oil that we use, up a little bit. The real pain was in precious metals. So it's funny, since we talked about, I think in our mailbag segment on Friday, I had a question on silver. I was talking about it. From that moment, silver's come off pretty good. And again, the long-term trend, again, it's always different between the short-term trend and the long-term trend. Definitely have seen a pullback in gold and silver. It's all about that longer-term trend and whether or not a trend is made of a series of up and down days. Do we make higher highs and higher lows on that longer-term time frame? That's what I'd be looking at with gold and precious metals. In terms of sector rotation, you saw again, the leadership today was industrials up almost 4%, financials up 3.7%. Some of those stocks like Citigroup, we'll look at a little later, that had been pretty rough, especially on a relative basis. Now just having these sort of bottoming patterns, more constructive patterns, breaking up to new swing highs, relative strength starting to emerge, especially in the last couple of weeks. So worth looking at and worth considering if you're not there yet. Energy also at the top of the list. So even though oil was not up in a big way today, the energy sector up almost 3%. At the bottom of the list, we have things like tech and healthcare. And again, this rotation away from technology, healthcare leadership has been relatively significant. If you look at the relative, the RRG, the XLK, and sorry, I'm throwing a lot of acronyms, look at the relative rotation graph, the technology sector, the XLK, and the healthcare sector, XLV, now have both rotated into the weakening quadrant. They're heading southwest, which is sort of the direction of underperformance. So we're seeing rotation away from those sectors into some of these other ones that are really emerging. Consumer discretionary, the most noteworthy, sort of emerging that position of strength, according to that methodology. Consumer staples also down, not down, up a little bit, but underperforming the market today. Communication services down at the bottom of the list as well. In terms of some stock movements that we've seen, again, I think the changes in the scooter rankings can be really helpful. This is the StockCharts technical rating. You have the top ranked stocks here on the left. These are the top 10 stocks based on that methodology. Wanted to point out just, I think, one financial stock at a quick glance in the top 10. That's Market Access, which is in one of the groups we'll try to look at momentarily. But you're seeing some retail names like GPS, Gap, like L Brands, both sort of breaking to new swing highs. And these are, again, stocks that a lot of people have written off. The price movements look reasonable, but if you look at the relative strength, you can see how big that these are. This is coming from $5 up to $12, which is a pretty meaty change in price. So this is down, almost 70% from June of last year. Now it's down only 40%, which is a huge reversal. And you can see the relative strength making new swing highs for the last couple months, price making new swing highs, chipping away higher highs, higher lows, up 12% today. So you've seen big movements on a percent basis with a lot of those names, and I think that's worth paying attention to. Twitter actually looks kind of similar to that. What's interesting with the Twitter chart is it's now back above its 200-day moving average for the first time since February. And when it was above there in February, it wasn't for long. It came right back down. That big move higher ended up being the peak for that sort of short-term cycle. Last time it was really above there was back here in mid-2019, trying to get above its 200-day. It is closed above it. I think the question now is, do you get the follow-through? But you see the relative strength has really started to improve. So again, some of these stocks that you may not have thought of as leadership names may be worth paying a little bit of attention to and seeing. And again, the way I'm looking for these is stocks with big changes in their scooter rating just in the last day. In terms of the percent moves in individual groups, just to wrap up, worth pointing out, airlines up pretty significantly today. It's about 8% up today. Again, you've had some big moves higher there on a group that has been beaten down on a relative basis. But again, relative gains tend to come when price gains are happening, especially in this sort of environment. So airlines as a group starting to break to new swing highs, new higher highs, higher lows. Worth looking at. Gambling as well, continuing to sort of go higher. And the aerospace group, which again, on a relative basis had been a real mess and now starting to potentially look more attractive. So some of these groups are up significantly today. Worth looking at how the trends have evolved. On the downside, again, we continue to see gold mining and mining at the bottom of the list. And again, it's more of a risk-off move. Gold price coming down, gold stocks coming on. Newmont Mining had been one of the top-rated stocks according to our Scooter rankings. Now rotating off of that list. And I think if you're still there, I'd question the staying power of some of those trends and see if it's worth rotating elsewhere. What concerns me are some of the groups at the bottom 10 list today, things like biotech, things like internet, which is a big group within communication services. Again, on a price basis, not down in a big way, but just not making a higher high, while other groups certainly are doing so. So worth looking at some of those in a little more detail when you have time here after the close. That's our market recap for today. Again, a lot of interesting movements, a lot of potential rotations, and a lot of groups starting to emerge that I think it's a really good time to revisit screens that you may have written off to see what's starting to work and what's starting to not work. We're going to take a quick commercial break. Back with my guest, Frank Cappelleri. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. I'm your host, Dave Keller, here at StockCharts. Thanks for joining us every weekday. As a reminder, we love to answer your questions. We had a great mailbag segment yesterday answering questions on equivolume charts, on trading rules, all sorts of different things. So please keep your questions and your feedback coming. We'll have another mailbag segment on Friday. Love to help you guys navigate this market. And if I can answer questions, throw questions in front of our guests for you, I'd be happy to do so. So shoot us an email, thefinalbar@stockcharts.com. We'd love to hear from you and answer your question on Friday's show. I want to bring on my guest, Frank Cappelleri. Frank's the technical analyst at Instinet, based in the New York area. Frank, welcome to the show.
Dave, thanks so much for having me. It's a pleasure to be here.
So, this is an environment where I've mentioned, the market climbing the wall of worry. It just continues to, I feel like, trip higher and higher and just sort of continue. What is your toolkit telling you about the current state of affairs for equities?
That's right. So I just wanted to go over briefly some of the factors that I use to derive a market stance. And to me, it all starts with analyzing in chart patterns. Now, it's difficult to follow Peter Brandt in this discussion, of course. He made a career out of that. But the reason is that the healthiest uptrends, if you think about it, are comprised of the most bullish patterns, both in appearance and how successful they are. And in that regard, for me, the market's complexion really changed on April 6th. And that's when, as we know, S&P broke out in 2650 and produced that measure move target of 3110. I got to say, David, timing is impeccable here because that target was hit today. That's a chart as of yesterday. So, but I think that's important because that's what you want to see. That's how uptrends get acquired. And there's other patterns out there right now for the S&P 500, but that was important because it's been 2 months in the making. And again, we don't have it here, but the next target will be 3190. Now, to get a better idea really why that April 6th was important, if we turn to the second chart, just to show how we came up with that. Now, as we know, during the time when the market crashed, February through March, there were some instances of some big updates, and each one of them produced a potential bullish pattern. Each one, of course, failed. And so we kept on looking for them, even though these didn't work out. And so when the market bottomed on March 23rd, again, no real indication that things had changed. And again, from my perspective, things did change when we finally got the first target achieved from a very short-term basis. That was at 2,700. And again, we need to see something like that occur before we can make a sense that there's a trend reversal.
Got it. You know, it's interesting. You point out a really good point. I think as the market was coming off here in February and March, there were a number of times where it felt like things were getting a little bit better, but then you continued to roll over. It shows you the difference in complexion there at the end of March when, you know, you started to really see, I think the higher low just felt like, you know, you started to get more momentum there, right?
That's right. That's right. And that's a good segue for the next chart, because the mirror image of that is occurring now. So you look at the beginning of that chart with the blue arrow, that's where we broke out through 2650 again. And you look at all the potential topping patterns that have come and gone since that point. And then really the only big scare up to this point was in the middle of May. We had that break through that trend line, but all that produced was another bear trap. And so this is what we're looking at. You know, anytime the market started to roll over, again, talking about the wall worry, you just think that that's going to be the big one. We're going down. Initially, that was the call for the test of new lows again. Now it's just to break the trend. So I think what we have to do is keep in mind that things are overbought, of course, but also realize that we can get whipsawed very quickly, thinking that any one of these can roll over. And
so it's interesting, right? So I mean, I think what I like about your work, Frank, is you're looking at the trend, clearly seen on the hourly chart, that continued up move. But this chart that you sent just intrigued me, the bear oscillator. What is it telling you about the characteristics of where we're at right now?
Well, this was just a way to really show how I'm tracking these bearish patterns in indicator form, because not many people are looking at this on an intraday basis every day. And so basically when bearish patterns fail, this oscillator remains in the tame zone, 0 to 3. And in this, on the other side, the indicator is on inverse scale here, just to show it better align with the market itself. And so when that happens, again, it happened on April 6th. We see how the indicator went back up into the tame zone, has been there ever since. And so again, look at other indicators that are overbought. If you just rely on that, you get a false sense of what's really happening. And so what this indicator does not do is call a top or bottom before it happens. Because again, you need to see some deterioration underneath the surface for that to occur. Once that does, when a downside target gets hit for the first time, the indicator will then move out of the tame zone and get into a more elevated risk environment. And that's what we saw at the end of February.
You know, so then we only have a minute left here, Frank, but I love that what you sent here, thinking about sort of the emotional components that come with these trends. We're looking at the trend that goes higher, but when you think about the mental state of investors, where are we at on this range from fear to greed?
That's right. We know that the bullish patterns are working. We know the price action is very strong. We also have to realize that we're probably getting to the other end of the behavioral finance pendulum, if you would. And so, people use different terms to describe this, but I think this really gives us a sense of sentiment and emotion. We all know how it felt during the fear and panic phase. It does not feel the same way now, at least market-wise. Outside the market, obviously, much other things are going on. But right now, as we look for a possible trend reversal, typically the biggest ones come after you get this emotional shift. So whether we're in confidence, enthusiasm, greed, conviction, if we're getting to a point where we have to think that at one of these stages, that one of these bearish patterns will actually prove successful.
This is a great take, Frank. Thanks so much for sending those, and thanks for sort of talking through this process. I love how you're connecting sort of this last one, thinking about the emotional state with the trends and just a market that remains resilient. Frank Cappelleri from Instinet, thanks so much for coming on the show today.
Thanks, Dave. Appreciate it.
Pleasure to have Frank on there. I think the last time I saw Frank was we had a dinner, as a group dinner in Boston, and it was before the holidays. I want to say it's been quite a while, and when we're all traveling, that seems like so long ago. So I'm hopeful that I'll Frank, able to see you and others very soon once we can re-engage the travel experience for us. Get on the road. Next segment, folks, is sector deep dive. And what we love to do occasionally is dive a little deeper into a particular sector, really think about the components. We talk a lot about sector rotation, and every week we look at the relative rotation graph, think about those 11 sectors and how they're rotating around the benchmark in the middle. But remember, each one of those sectors is comprised of groups and individual stocks and themes, and there's a lot to be gained from sort of digging that next level down. Part of my weekly process every Sunday is to go through the S&P 500 by sector and think about some of those group themes and how they're changing. So what we wanted to do today was dig a little bit into the financial sector, just talk about some of the patterns that we're seeing. As a reminder, in a limited time that we have in a 30-minute show, this is not an exhaustive coverage of the financial sector. My goal with this is to introduce the idea, to sort of hit on some of the themes that I'm seeing and give you hopefully some inspiration to do some of your own digging and see what patterns you can identify. What I like to do for this sort of analysis is start with the industry summary page, and that's after I've looked at the chart of the XLF. We'll get to this point. If you're not familiar with this, just go to Charts and Tools at the top header of our website, and you'll find industry summary as one of the choices. This breaks down the 11 sectors by the groups that we consider part of each sector. At the top, I switch to the table views as sort of my process, go down to financials, and I sort it by the Scooter ranking. So we rank all the industry groups, it's just over 100 of them, in order, in percentile ranking based on their trend. So the higher the number, the stronger the uptrend. So what's interesting within financials, you have a range from 97th percentile, that's the specialty finance group, which we'll look at first, down to the 14th percentile for some of the insurance groups, full line insurance and life insurance. Let's hit on a couple of these, just look at some of the stocks that are comprising these patterns. So here I'm looking at specialty finance. I'm going to sort this group based on its Scooter ranking so I can see the top names within this group. And you'll see some of the names you probably are familiar with. So within financials, where a lot of the stocks are sort of struggling to recover their 200-day moving average, a lot of them not even there yet, as the S&P has now eclipsed its own 200-day. Just a reminder, you have stocks like S&P Global, SPGI, which is within that specialty finance group. This is the top-ranked group based on its trend for a reason. This is actually a stock that's at new a 52-week high. It broke a couple of weeks ago, broke to new highs. It's an interesting one because it's tested that high end of April, sort of made this, and that's not a beautiful cup and handle, because a cup, you'd rather it be more of a rounded bottom. This is sort of a V-shaped cup and handle, I guess. But it did have a resistance level that it broke through, retested it around 310, and now has continued higher up again today. But the relative strength has been consistent, and it's overbought. What's interesting about this one is if it's able to hit that extreme overbought range with an RSI above 80, that usually means is maybe a brief stop, but usually at least one leg higher as it goes, because the momentum is so strong. So that's a name worth watching just to see if that condition is satisfied. Other groups within there are things like Moody's. Moody's is similar to what you saw with S&P Global, but it's a little early on. So it's testing its February high. I think it'll be really telling for when you think about financial leadership, you think about the market health overall in this rotation away from tech and healthcare into things like financials. If a stock like Moody's is able to eclipse its February high, make a new 52-week high, continue to push higher on a relative basis, I think that could be really interesting. A lot of people see when it reaches the overbought region thinking that's automatically a bad thing. It could be, but it's not yet. So concerns are a stock making, reaching its previous 52-week high, reaching an overbought condition. As a reminder, a very similar thing happened last December, and that was before the stock went up for another 2 months. So just because it's overbought just means it's up a lot. That doesn't necessarily mean the end of the move. There are other things that would tell us potentially when that uptrend is over, but worth watching to see if MCO can eclipse that key resistance level. Going back to the industry summary page, that's the specialty finance group, and it's a lot of names like that. It's exchanges and others. I want to look at a couple other groups just to give you a sense of where some of these are at. This is within asset managers, which is sort of a mixed bag of things, but BlackRock maybe comes to mind as a good example stock to look at. So again, the stocks in some of these top ranked groups usually have round tripped or near to that. So you had SPGI sort of up here, you had Moody's sort of right here testing support, and something like BlackRock is not quite there. It's a little earlier on. So stocks within this group, though, still up pretty good from their March lows. You can see the relative strength has improved dramatically from the March lows. These are stocks that that underperformed going into the low, but have outperformed pretty well. A lot of that came right at the beginning, but it's continued to chip away. The relative strength overall is trending in the right direction, not yet overbought, and overall in a pretty decent shape. And again, those are uptrends that just have continued to chip away higher. So I think worth looking at. Also within this group, you have other stocks, things like Eaton Vance, that are maybe a little earlier, right? So these are stocks that have not yet eclipsed their 200-day moving average. The question is, are you able to get an RSI above 60? This is what the S&P did about a week or two ago. It was in this configuration where you saw it topping out, hitting resistance, now potentially breaking above its 200-day. The RSI potentially getting above 60, making new relative gains. Could be attractive as a group pushing to new highs, their new swing highs. Maybe one other group we have time to look at. I did want to look at the banks group. So this has some big cap names in here, things like Citigroup. There's a bunch of stocks in here, and some of the regional banks are in here as well. So it's sort of a mishmash. So boy, I'm going way down the list to find Citigroup, which is a bit of a concern here. Where are we at? Will I reach Citigroup? All right, I'm going to bring it up on its own. That's a bad idea to try to find one ticker visually like that. Right, so Citigroup within the bank sector, where's it scooter? 18. I just wasn't patient enough to get down to the 18th percentile. But so if you look at it, it looks a little bit like one of the asset managers we looked at, right? So has gotten above its 50-day, that's good. Gotten to new swing highs, that's good. Making higher highs and higher lows, that's good. Making a new swing high today, up 5%, which is good. So a lot of these banks had bearish engulfing patterns last week, which we focused on. It's more of a short-term indication, though, now starting to regain that high from that pattern, but pretty far below its 200-day moving average. So it's not sort of swinging above that key metric, but the relative strength starting to improve. I think with stocks like Citigroup, and this is why the sector as a whole is not lights out going up, because some of these stocks still are starting to improve. They're earlier on in that trajectory. They're not making new highs. They're not teasing new highs. They still haven't regained their 200-day, but the relative strength is starting to improve. And what I'd be looking at for some of these charts is to see whether that follow through occurs. Other big cap names, and this is the last group, investment services, I'll point out, this is Goldman Sachs. So it has eclipsed its 200-day moving average, now rotating back above the bearish engulfing pattern happened as it was hitting its 200-day moving average, which started to feel a little negative, but you can see it's now again regained the swing high. So the sector as a whole has started to improve. The XLF in general starting to improve, making new highs, swing highs, higher lows, the relative strength starting to improve. But again, I'm looking at some of those key stocks, the next level down, and see if more and more of them can eclipse those key resistance levels. Can stocks like MCO make new 52-week highs? Can a stock like Goldman Sachs hold its 200-day? Can a stock like Citigroup continue to rotate higher? And if so, that's how the XLF is going to continue to outperform. And again, if you're not there yet in terms of financials outperformance, I'd certainly be looking there to see if there are some opportunities. We need to wrap the show. That was a deep dive into the financial sector. We need to go right to the 3 and 3 and wrap up this 30 minutes of fun together. Chart number 1 is looking at the S&P 500 at the top, stocks making new 52-week highs and lows. This is pretty compressed because there were so many new lows here in mid-March. 2/3 of the S&P 500 or 60% at least making new 52-week lows in the middle of March at the market bottom. So it sort of skewed everything down a little bit. It's worth noting that 5 to 10% of the S&P starting to make new highs. That's a decent number. If you'd want to you want to see this continue to steadily improve. It looks like it's a zero because it's so compressed, but I'm looking at this chart, and as it continues to increase, that means more and more stocks like Moody's are able to eclipse their previous highs from January to February. So that's a metric I'm going to be looking at. So far, starting to improve. Chart number 2 is looking at the S&P breadth by cap tier. So this is a very subjectively colored indicator looking at cumulative advanced decline for the S&P, for mid caps, for small caps. I think it's positive for large, for mid, for the broad NYSE, just not quite for small caps yet, but getting there. And that's because it's not quite made a new swing high yet. But overall, in this measure of breadth, things are improving a little bit. And then the last thing I would look at is the consumer sector. If you look at the XLY versus the XLP making new 52-week highs this week, if you look at the equal weighted version also making swing highs, so this takes the overweight of Amazon and Home Depot out of consumer discretionary. It's more of a broader measure of performance. An interesting one we don't have time for, but I would encourage you to look at the XLY versus the XLK. Look at consumer discretionary versus technology. It's not an incredible relative story yet, but it's getting there. Folks, that's our show for today. I want to thank Frank Cappelleri from Instinet joining us from New York today to give his take on the world. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.